Okay, hello everyone, and a very warm welcome to FSM Choice Awards 2023. So my name is 𝗪𝘃, and I'm from the research team at iFAST. So in this short 15-minute session, I aim to share 3 investment ideas which we think investors should be paying attention to. So we are a little bit stretched on time today, so let's jump right into our first idea, which is on Japan. So Japanese equities, they have quite the year, with the domestic equity indices all hitting record highs lately. So both the Nikkei 225 and also the TOPIX, they have risen by close to 20% year to date. So this rally in Japanese equities has also reassured our call for them, as we have been positive on them since last year. But despite the fierce rally, Japan, it still remains our top equity market pick and also our largest overweight in our portfolios at the moment. And over the next few slides, I'll be sharing a couple of reasons why we like Japan and also why we think this market rally can continue. So the first reason, it has to do with the ongoing reopening tailwind. So tourism, it is an important part of the Japanese economy. And before the pandemic in 2019, tourism, it contributed about 7% of the nation's GDP. And to give you guys some perspective, that number is roughly equivalent to Singapore's GDP in 2019. And ever since Japan started to reopen last year, tourism has rebounded significantly, which you can tell from the chart on the right by the number of visitor arrivals in Japan, and also by the sheer number of people posting Instagram stories of their travels in Japan. And according to the data from Japan's tourism agency, tourist spending has recovered to roughly 95% of pre-pandemic levels, and that has provided a huge boost in consumption to the Japanese market. However, we think that there is still room for consumption to climb, as the number of Chinese tourists, they are still far from their pre-pandemic levels. So assuming all these Chinese tourists return, we can easily expect consumption in Japan to surpass their pre-pandemic levels. Moreover, domestic consumption in Japan has stayed consistently strong over the past 2 to 3 years. As a matter of fact, Japan's higher inflation, it does little to impede the spending of Japanese consumers. And if you look at consumption, it has rebounded significantly in real terms, driven by a strong rebound in services spending. And with consumption making up roughly 2/3 of the Japanese GDP, and that should help to compensate for the weaker export numbers and also adds resiliency to a market at a time where global headwinds are mounting. Now, for our second reason, the second reason why we like Japan is because of its corporate fundamental strength. So despite the challenging quarter, more than 60% of Japanese companies still managed to beat their earnings estimates thanks to better revenue growth and also improving profitability. And we do expect Japanese equities to continue delivering strong double-digit earnings growth over the next couple of years, beating the US and also the European peers. So additionally, Japan's corporate balance sheets, they are also in a strong position. So Japanese companies, they are cash-rich, okay? So as a matter of fact, if you look at this chart over here, you can see that more than 50% of Japanese listed companies, they are in a net cash position. So what this means is that they have more cash and also liquid assets compared to their total debt. And this is really impressive because the figure is actually more than double compared to its US and Euro-listed companies. And having strong balance sheets, it is important for obvious reasons in the event of a slowdown, but it also helps these companies to maintain their dividend payouts in the event of a downturn. Now, moving on to the third reason why we like Japan, and it is because of its attractive valuations. So even though valuations have risen quite a bit after the rally, they are not overly expensive yet, unlike other developed markets, such as the US, for instance. So on a historical basis, Japanese equities, they are also not as expensive as before, and we can clearly see that the rise in share price today, it is well supported by robust earnings growth, unlike during the 1980s asset bubble, when you can see very clearly that share prices, they went way ahead of earnings. And with the Nikkei's forward PE still well below its long-term average, we do think that Japanese equities have more room to rise. So lastly, the Tokyo Stock Exchange has also started to pressure companies with low price-to-book ratios to more efficiently use their capital or potentially be delisted. So this campaign to improve shareholder value has been rather effective, as many Japanese companies, they have responded with things such as share buybacks, increasing dividend payouts, and other improvement measures in the recent months. So to sum things up, we like Japan for its reopening tailwinds, strong balance sheets, attractive valuations, and in general, a brighter, longer-term outlook. Now, for our next idea, I would like to share about one of our favorite sectors, which in our opinion has immense growth potential. So if you're guessing semiconductors, then congratulations, you're right again. So let me start with the biggest reason why we like this sector so much, and it has to do with the simple fact that the world we live in, it is becoming increasingly digitalized, which should result in rising demand for semiconductors. So more broadly speaking, we see two structural factors driving semiconductor demand. So the first is an increase in the number of semiconductor applications, and the second is the rising silicon content in them. So in the past, semiconductor demand, it is primarily driven by personal computers, which was the dominant end-use market at the time. These days, however, there are countless applications that require semiconductors, ranging from your everyday smart devices to self-driving vehicles and data centers, just to name a few. And recent innovations such as your AI chatbots like ChatGPT and the metaverse, these things were only made possible because of advancements in semiconductor technology. So overall, I think that this AI rush, it will be a tremendous opportunity for semiconductor companies to capitalize on over the next decade. And the reason why is because AI systems, they rely heavily on hardware that can handle multiple tasks simultaneously, such as image processing, speech recognition, and also making complex decisions within a short span of time. And all these things, they can only be done by advanced computer chips. And as these applications, they become increasingly complex, I think it's logical to assume that the demand for semiconductors, it will continue to trend higher. And although the AI chip market, it is still in a rather nascent stage, as you can see from the chart over here, we think that there is plenty of room for growth as more and more businesses, they start to incorporate AI. And according to projections done by several market research firms, the AI chip market is estimated to exceed more than $200 billion by the year 2030, which equates to a compound annual growth rate of about 30% from today. So if you want to cash in on this AI rush, I think instead of buying all the AI companies, one good way for you to do so would be to buy the semiconductor companies because they are the foundation of AI. Now, aside from the growing number of semiconductor applications, I think one other reason that will contribute to the greater demand for semiconductors is the rising silicon content in existing applications. So if you take cars, for instance, even though cars, they are still largely mechanical since the start of the 21st century, thanks to new innovations such as autonomous driving, self-driving vehicles, the silicon content in cars today, it is estimated to have grown by more than 5 times compared to a decade ago. And if you look at this slide, according to projections made by Intel, semiconductors, it is estimated to make up more than 20% of a vehicle's cost by the year 2030, which is a 5-fold increase from today. So similar trends can also be observed in other applications as well. So the bottom line really is this. As the world becomes increasingly tech-driven, the demand for semiconductors will become even stronger than before, and this will bring immense benefits to the entire industry as a whole. So if you are familiar with the semiconductor industry, then you should know that the industry is notorious for its boom and bust cycles. So right now, the industry is actually in a down cycle, with sales growth falling by more than 20% year on year in the second quarter of 2023. So this can be good news or bad news, depending on how you look at it. So most down cycles, including the one that we are in today, they are mainly driven by imbalances with supply and demand. So during the early days of the pandemic, when many people were stuck at home, many of us were buying consumer electronics for home entertainment and to work from home, things like that. And businesses, they also use this opportunity to invest in technology, to digitalize their operations in order to stay competitive throughout COVID. So unfortunately, this sharp rise in semiconductor capacity is now met with falling demand as the global economy slows, and that has led to a supply glut, which is why you see negative sales growth coming out of the industry right now. So as a matter of fact, TSMC, which is the world's largest foundry and semiconductor producer, it projects that the inventory correction could last throughout the remainder of 2023 before things start to pick up in 2024. So why did I say earlier that down cycles, they can be good news? So the reason is simple. This is because down cycles, they often bring about the best buying opportunities in semiconductors. So if you look at this chart over here, it shows that history has shown that down cycles, they are temporary and they don't last forever. And semiconductor sales will eventually recover to higher levels than before. And that is because the world we are living in is becoming increasingly tech-driven and hence rising demand for semiconductors. So therefore, it is not a question of whether or not sales growth will recover, but rather it becomes a question on when will this recovery take place. And by our estimates, we think that this industry could return to double-digit sales growth as early as 2024. So even though valuations for the sector, they are not super cheap right now, but I think at the same time, they are not overly expensive as well. So for investors who believe in the long-term growth story for semiconductors, or for those of you with a longer investment horizon, I think this is one idea that you can consider investing in. And one way you can do so is you can start with a regular savings plan and eventually move to lump sum investments should valuations fall in the future. So if you've been enjoying a meal and you haven't been listening throughout this session, I think I can sum up my investment thesis in this slide. So it's really simple. And it's that without semiconductors, all the technology that we enjoy today, it will not exist. And again, as the world becomes increasingly tech-driven, the demand for semiconductors will continue to rise. All right, so now let's move on to our final idea, which is probably not as exciting as semiconductors, but I think it's still relevant given the current economic environment that we are in. And yes, I am talking about fixed income. So on asset class level, we continue to prefer fixed income over equities. So for many years, absurdly low interest rates as a result of accommodative monetary policy meant that bond yields, they offered very little returns to investors. So this has also led investors to adopt the mantra of TINA, or there is no alternative, as they saw equities as the only reasonable option to generate returns for their portfolios. But this is no longer the case. Central banks across the world, they have raised interest rates substantially and have vowed to keep them higher for longer to combat inflation. And this has also led to rising bond yields, offering investors the potential to earn larger returns and also underpinning the attractiveness of fixed income as an asset class. And as a matter of fact, if you take a look at this chart over here, you can see that the spread between the earnings yield and the bond yields are at one of the lowest points in a decade, suggesting that bonds, they are now relatively more attractive compared to equities. And within the fixed income space, we have a preference for investment-grade bonds over high-yield bonds, as we believe that a more defensive positioning is desirable and frankly important in a slowing growth environment. So despite this slowing economic growth, the yield premium of high yield relative to investment grade has not risen above its long-term average. And we do believe that higher yield premium is warranted for high yield issuers, as these issuers, they could face tougher access to credit as the macro backdrop continues to weaken, and that should pave the way for a widening in credit spreads. And in terms of duration, our preference is actually for shorter duration bonds. So if you look at the US Treasury yield curve, it is still deeply inverted, with yields on shorter duration bonds are much higher compared to the longer end. So this allows investors to receive greater returns without having to take on greater duration risk. So the same thing can be said for the Singapore bond market as well, as if you look at the 6-month T-bill, it is yielding considerably higher compared to the 10-year government bond. And so if you're looking for somewhere to stash your cash while opportunities to emerge, I think these are some things that you can consider: short duration bonds, T-bills, and money market funds. So before I go, and speaking of places to park your cash, I think another option that investors can consider is FSMOne's Auto Sweep account, which is a cash management account that is managed by FSM on a discretionary basis. I know that JP touched on this earlier, but I promise you this is a coincidence. I'm only sharing this because I genuinely like this product. So FSM Auto Sweep, it is available in 3 currencies at the moment, with the USD account, USD version having just introduced just a couple months back. And currently, for the USD version, it is also offering an attractive yield of up to 4.5%, which is the highest among the 3 currencies. So the beauty of the Auto Sweep account is that it allows you to earn higher interest on your idle cash. And then furthermore, you can also utilize the funds immediately to pay for your investments, such as your stocks, bonds, ETFs, so on and so forth. There is also no lock-in period, unlike fixed deposits, and no fees will be charged if your account balance falls to 0. And we also understand that because liquidity is important to everyone, which is why our USD and our CNH auto sweep allows you to get your proceeds back within a day. So I personally use this, and I really do think that the yields on the USD auto sweep, it is quite attractive compared to some of the similar products that you can find in the market out there. So if you're looking for somewhere to park your cash, I think this can be a good alternative as well. All right, so ladies and gentlemen, I've come to the end of my sharing today. Before I leave, I'd just like to wish everyone here all the best in your investing journey, and I hope that all of you can make lots of money this year. Have a good evening.